Hello and welcome to Russell Investments Market Week in Review for the week ending June 9th, 2023. I'm Zoe Wargans, and today I am joined by Paul Eitelman, our Chief Investment Strategist in North America. Thanks for coming, Paul.
Yeah, happy to be here, Zoe.
Yeah, always a pleasure. All right, so let's dive right in here. Now that the debt ceiling has been lifted, investors' focus is shifted over to how the market will be able to handle this sort of huge influx of Treasury issuance.
Mm-hmm.
Can you give us a little context on that and what some of the risks might be?
Yeah, sure. So to continue operations while the debt ceiling negotiations were happening, the Treasury had to draw down its cash significantly. And so it's sitting at around $50 billion right now. Normally, they like that cash account to be up at closer to $600 billion. And so there's going to be a lot of money raised, both to replenish the cash account and meet deficits here. And what we're seeing in terms of the estimates are it could be something like $850 billion in total by the end of September to get those funds back up to where they'd like them to be. That's a big number.
No kidding.
It's not unheard of, but we've only seen issuance like this during crises for the most part. In 2020 around the big stimulus program, in 2008 around the big stimulus program. So it's rare, but not unheard of. There's a couple of risks to have in mind around this that we're tracking. The first, given most of this money will be raised in T-bills, short-term funding markets, there's the possibility that some of those funding markets could become illiquid and strained. And so it'd be a reasonable expectation to think that Treasury bill yields might trade in excess of Fed expectations that are embedded in overnight index swaps. And so that's going to be an area that we're looking at. The other one is around where this money will come from, who will buy the Treasury bills. It's, again, a big dollar amount. And there's a possibility that it could come out of bank deposits, out of people's banking accounts. And that ties back into some of these banking stresses that we've seen since March. If banks all of a sudden face deposit outflows again, maybe that'll put some additional pressure onto a strained sector of the economy. I'd say by and large, this is a known risk that a lot of investors are talking about. And so usually when that's the case, the market impact as it plays out tends to be small, but there are a couple of risk channels, as we've talked about, that we're keeping an eye on here.
Makes sense. Yeah, this has been an interesting development for sure.
Yep.
Let's turn actually now to the central banks in other parts of the world.
Sure.
The market was caught off guard by the rate hikes in Australia and Canada. So what do you think we've learned from that particular experience?
Yeah, I think in both of those economies, we're seeing fairly resilient economic growth, and the central bankers are still worried about some persistence or upside risks to inflation dynamics. And so as you noted, in both of those cases, the central banks hiked by 25 basis points, and it wasn't an expected move. Investors were caught off guard. I think Australia is maybe the more interesting of the bunch because this is now the second meeting in a row where they've surprised investors with a interest rate hike. And there's that old saying, fool me once, shame on you, fool me twice, shame on me. And so I think investors are thinking about that now and have repriced actually some more rate hikes from Australia. I think two of them now out into the end of 2023. And so that's created some upward pressure on yields in the Australian fixed income market. But yeah, again, the Bank of Canada was similar in terms of being a surprise. There's interesting questions to think about. Like we have a very important Federal Reserve meeting next week on Wednesday. Will the Fed follow this same template or not? Will they also surprise? I think the bias is usually to try to not surprise investors. And the soon-to-be Vice Chair Philip Jefferson, right before they went into their media blackout period ahead of this meeting, pretty strongly hinted towards them pausing. So that's our expectation, but we'll see. And we'll also be looking for what kind of guidance they provide in terms of the future of U.S. monetary policy as well.
Absolutely. Should be interesting to see how all of that comes out together. All right. So finally, let's just do like a quick recap on how equity and fixed income markets are performing as of right now.
Yeah. So sitting here on Thursday, it's been a pretty volatile week in U.S. markets, though. Point to point, we're sitting fairly range bound. The S&P 500 index is up about 20 basis points, which is more or less flat in the scheme of things. But it has been an interesting market this year with wide divergence under the surface of those aggregate index levels. A lot of strength driven by just 7 very large mega cap technology companies, and the rest of the market has been closer to flat and reflecting on a lot of the economic concerns that we've been talking about. Similarly, in fixed income markets, U.S. yields didn't move a ton. Sitting here on Thursday, again, 10-year Treasury yields are only up about 2 basis points. More of the action was felt in non-U.S. Fixed income markets because of those central bank surprises that we talked about. That Australian 10-year yield is now shot up almost to 4%, which is the highest it's been in many, many months now.
Wow. Paul, thank you so much for providing us with all of that insight. It is always a pleasure to talk to you.
Yeah, happy to.
And thanks to all of you for joining us. Please see us again next week.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.